So things are about to get worse. Big surprise. Fed Chair Jerome Powell has now warned us that the fight against inflation will be painful. I think we all expected that, but does it mean that a crash is coming? Be sure to stick around with us as we dive in and find out. Jerome Powell now has warned that the central bank's quest to curb inflation will result in some pain for American families, meaning you and me. And in his recent remarks at the annual Federal Reserve Economics Seminar in Jackson Hole last Friday, Powell said that the road to lower inflation will not be fast or easy, adding that the challenge will require using our tools forcefully to bring demand and supply into better balance. Doing so, he said, will probably involve a degree of weakening in the U.S. economy and the labor markets. Powell was quoted saying, while higher interest rates, slower growth, and softer labor market conditions will bring down inflation, they will also bring some pain to households and to businesses. Strategists and economists are seeing this as a sign that the Fed is willing to see the unemployment rate creep a little bit higher in order to reduce demand. This is because a weak job market typically curbs consumer demand as households hoard cash ahead of a potential job loss. And we've been recommending hoarding cash now for many months. Powell also conveyed more urgency to contain inflation than in past statements, calling price stability the bedrock of our economy, and saying that, and I quote, "Our responsibility to deliver price stability is unconditional." Though Powell did not give any indication whether the Fed's remarkable consecutive rate increases of 75 basis points each will be repeated in the rate-setting meeting in September, he did send the clearest signal to date that the central bank is unambiguously committed to tighten their policies in an effort to curb the inflation problem right now. Now, this raises the likelihood of additional rate hikes in the near future, so be ready for that. And how do we get to the inflation rate that we're at now? What does it tell us about the Fed's ability to use their policies to stave off inflation? Let's go ahead and take a walk real quickly down memory lane to some of the key moments in the path that inflation has taken over the last 20 months now. Starting back in January of 2021, when President Biden was inaugurated, inflation was sitting at about 1.4%. At the time, Biden said that U.S. faced a deep economic crisis and proposed a $1.9 trillion stimulus. On February 23rd of 21, inflation rose to 1.7%. At the time, Jerome Powell was quoted saying, "I really don't expect we'll see a situation where inflation rises to troublesome levels." On March 11th of 21, Biden signs the $1.9 trillion stimulus known as the American Rescue Plan Act, and inflation creeps up to 2.6%. Around the same time, former Obama Treasury Secretary Larry Summers then predicted major recession and years of high inflation and unemployment. But Treasury Secretary Yellen disagreed. She went in and said that is there a risk of inflation? I think there's a small risk, but I don't think it's a significant risk. Fast forward to June of 21, inflation increased to already 5%. Yellen acknowledged inflation concerns for the very first time. At the time, she said that transitory or temporary factors were causing it and predicted 3% inflation for 21. That's 2021. Around the same time, Fed Chairman Powell was quoted saying, "Inflation could turn out to be higher and more persistent than we expected." On July 19th of 2021, Biden acknowledged some prices increased, but called inflation a result of temporary supply chain issues. He said, "Some folks have raised worries that this could be a sign of persistent inflation, but that's not our view. Most of the price increases we've seen are expected to be temporary," is what he said. Inflation at that time was sitting at 5.4%. Then on November 10th of 2021, inflation hits a 30-year high at 6.2%. Biden calls stopping inflation a top priority, and Fed Chairman Powell says inflation is not transitory, and it's probably a good time to retire that word. Things would go from bad to worse in February and March of this year, with inflation rising all the way to 8.5%. As we know, Russia invaded Ukraine in February, and the West responded with broad sanctions. And those sanctions then led to price increases on oil and natural gas and cooking oils and grain. And then on March 16th of 2022, the Fed raised interest rates for the first time in an attempt to slow down the economy and bring down the inflation. On June 15th of 2022, after having seen very little effect with their first rate hike, the Fed decided to raise its benchmark interest rates by 75 basis points, which was the Fed's most aggressive rate hike since 1994, folks. And at this point, inflation is sitting at 8.6%. Then in July of this year, inflation hits 9.1%, which was a 41-year high. And Biden calls this level of inflation unacceptably high. The Fed took steps by adding an additional 75 basis point rate hike during its July 2022 meeting. And since then, inflation has been able to stall out a little bit, falling to 8.5%. The fact that we've seen a decrease, albeit a small one, is a good sign, as controlling inflation rapidly is critically important, as expectations for inflation could turn into a devastating self-fulfilling prophecy. I mean, Powell had this to say on that note: the longer the current bout of high inflation continues, the greater the chance that expectations of a higher inflation will become entrenched. The role that the public's inflation expectations play in inflation overall is really unknown because it's extremely difficult to quantify that. But the good news here is that it does appear that the Fed has not lost its credibility right now at this point, making the public's inflation expectations less of a risk moving forward. But not everybody's convinced that the Fed has things under control. A paper published during the summit in Jackson Hole last week suggests that the central bank cannot get things done on its own and that it can worsen things by raising interest rates. The paper says that without a fiscal spending limit, raising rates would make debt costs even higher and push up inflation expectations. Many economists, however, expect that various factors will combine to bring inflation down, helping the Fed to its task. Federal Reserve Chairman Powell said on Friday, the central bank has an unconditional responsibility to reduce inflation, expressing confidence that it will get the job done. The aforementioned paper was written by researchers Francesco Bianchi at Johns Hopkins and Leonardo Malosi of the Chicago Fed. In it, they claim that in the current situation, inflation is being driven in large part by the tax expenditures to deal with the COVID crisis, and merely raising the rates, it won't be enough to push it back down. In the paper, the authors actually quote, "The recent fiscal interventions in response to the COVID pandemic have altered the private sector's beliefs about the fiscal framework, accelerating the recovery, but also determining an increase in fiscal inflation. This increase in inflation could not have been averted by simply tightening monetary policy. The Fed then can bring down inflation only when public debt can be successfully stabilized by credible future fiscal plans." This means that without constraints in fiscal spending, rate hikes will make the cost of debt more expensive. It'll drive inflation expectations higher. Bianchi and Malosi argue the commitment of the Fed is just not good enough. Even though they agreed on the expectation side, instead, they argue the high levels of federal debt and continued increases in spending by the government are helping to fuel a public perception that inflation will stay high. According to usaspending.gov, Congress has spent roughly $4.5 trillion with a T dollars on COVID-related programs. Those spending efforts led to $3.1 trillion in a budget deficit in 2020, a $2.8 trillion shortfall in 2021, and a $726 billion deficit over the first 10 months of 2022's fiscal year. As a result, the federal debt is running around 123% of gross domestic product. This is a slight drop from the 2020 record of 128%, which was due to COVID, but still far higher than anything we've seen since at least 1946. Immediately following our spending binge during World War II. Again, to quote the paper, when fiscal imbalances are large and fiscal credibility wanes, it may become increasingly harder for the monetary authority, in this case the Fed, to stabilize inflation around its desired target. Moreover, the study found that if the Fed really continues on its rate hiking trajectory, it may worsen matters. And that's because higher rates would mean the $30.8 trillion of national debt becomes even more expensive to fund. As the Federal Reserve raised its benchmark interest rates by 2.25 percentage points this year, the Treasury's rates have soared. In the second quarter, the interest paid on total debt was a record of $599 billion at the seasonal adjustment annual rate, according to data from the Fed. Powell said last Friday that the Federal Reserve is doing everything they possibly can to avoid a scenario like that one that occurred in the 60s and then in the 1970s, which increased government spending combined with a Fed that was unwilling to maintain elevated interest rates led to years of stagflation. That environment persisted until Paul Volcker, the then Fed chairman, led a series of extreme interest rate increases, which ultimately sent the economy into a deep recession and helped to keep inflation under control for the next 40 years. Bianchi and Malosi are worried that the same recipe used to defeat the Great Inflation in the early 1980s may not be as effective today. Curious what your thoughts are. Is the Fed doing enough to combat inflation, or are they merely making matters worse? Let us know in the comments below. Let's have a dialogue about this, folks. Also want to encourage you to understand that inflation is not going to all be bad as long as you're playing your cards right. I'm going to be releasing an upcoming video showing how inflation can help you if you're the recipient in the matter, because rising prices are happening universally, and that means that you can certainly benefit. So make sure to not just like this video, it helps us a lot with the YouTube algorithm, but also consider subscribing so you get notified when that video launches. Share the video with anybody you think this might help. And until we see you on the next video, make it a great day today, and more importantly than anything, keep on cash flowing. We'll see you on the next one.